end of the week, of course, going into the weekend. And I want to just touch on some of the things we've been covering this week so far. We're talking about algorithmic buying and selling. Now, obviously, that gets chucked out the window when everything gets trumped by a global political narrative kicking off. Obviously, in the case of the Israeli action against Iran as nuclear program, so a lot of things get chucked in the bin at that stage because we move into a different type of marketplace. The concept of excess becomes even less important in some respects in that way, and we're going to have to get the definitions clear. We also talked about buy sell programs in the micro world as well. And a lot of people wonder about the value of seeing buy and sell programs in the micro world. I think it was Ulrich asked, can we do buy and sell programs on a 30-second chart, for example? Well, if you look at this chart here, I wonder if you can see the buy and sell programs. Now, what I've done is I've just converted the buy and sell programs into a MACD so that you can see it as a histogram, right? So it should be, if the histogram's going up, you're getting a discount. If it's going down, you're getting a premium, and you should be able to sell into those. If you can see that histogram, can you spot any really interesting trades from a pocket of liquidity, yes or no? Can you see any really interesting trades that you might have been able to take advantage of, bearing in mind you're trading the red line? Well, it's kind of obvious where some of them are located, right? You can see if we go back a little bit further, you'll see some crazy sell opportunities up here. You know, you can see that the PREM is driving into the sell side, but yet you're able to pick off these top line prices and make some nice scalp money. When the price then sweeps the stops at the bottom edge, the PREM is now giving you a buy trade, and you could have made some scalp money on the buy side over the next 1 or 2 minutes. You can see here that it's strongly churning around into a buy here, and you're running into a bottom edge. Great buy opportunity. When you see the sell coming in, you see that's dropping off here. You maybe got a sell, maybe a little bit light. This looks fair, so you don't bother with your short with this one. Into the bottom edge, do you see a possible buy trade in here? Nice, right? Nice opportunity at 3:30 to go long equities. This one, well, into liquidity, not quite, but you could have made a couple of scratches on that one before the value comes away, and then you say, okay, we're going back to the press, the top edge. What about a sell trade up here? Nice outcome, right? Nice outcome. Good opportunity to sell it. Did that make you some solid money? Sure. Beautiful. Beautiful. Kind of neutral bottom edge here. A bit of buying perhaps on the drop here, but when it drops down a little bit here. So you'd have to be careful with this, but it looks bullish because of the fact that it's been dropping into a rising phase here. You know, and obviously when it rises, you're back into a good solid green phase. We get a good pop to the upside, solid red phase. We don't quite get a top edge to sell into for that one. Disappointed perhaps. You can see that in the last couple of plays here, it's starting to seem as if it's getting a lot more bullish net across the bottom edges now. So if you were to run a sweep into a bottom edge, which hasn't happened, you'd be certainly buying this at the present moment, right? So again, you can see that there is value to these little models. And the value a lot of the times comes in the form of just simply knowledge, adding it to a value storyline that's maybe brewing in the background. Looking at this against, for example, your price of volatility can start giving you some ideas about where the opportunity maybe existed. So you can see, for example, into the bottom edge here where we saw that very sharp change in value from the PREM, you're now looking at the value itself and saying, but wait a second, this is still dropping hard here. And when that turns, you say, I am now all in here for a buy trade, right? And again, when it comes in here, you say, I'm all in for a buy trade again here. And when it then comes back in again here, you say, I'm all in for a buy trade again here. You'd have done bloody good. You would have taken that trade and you would have been able to buy in there at 59.78s. And by the time you're over at this side of the chart here, you're 59.94s. 78, I said. 78. This over here is 58.95s. 59.95s. This trade, 59.80s. So you're looking at this area here and saying, well, that's about a 15-point profit on that swing. 15 points profit on the swing. If you've got a 15-point profit on a scalp trade, because you might say, but what about a possible sell trade here? Yeah, but it's not into liquidity. Remember, you're also trying to find trades that are maybe scooping up some of that lovely stuff. There's a liquidity area there. You're trying to find reasons to buy into that liquidity. Well, if I was trying to find reasons to sell into liquidity, I'd probably have been looking at this, maybe this pivot over here, and I maybe says, right, if I got that price, I might be interested. But until we've put in a pivot, we've not really put in a pivot. And then we don't have any add value here, so that just kicks in, and we kick off to the top side, and we just keep working through these processes. You see a beautiful sell-side value divergence here. This is already into liquidity. So when that's dropping out of bed here, you're saying, well, you know what? I'm going to take a shot at some of these. So it's like what we talked about earlier when we were talking about these indicators. It's all right having a value line, but do you need it? Is it something that you were asking to find? Is it that type of storyline? Because if it's not, you shouldn't be putting it on your chart, because it then just becomes noise. It becomes a something else to give you an excuse not to take a trade. And that's the biggest problem for most retail traders, is they always find excuses for not doing business. Always. Because they want more software. Obviously, my software is not good enough. That's why I'm not making money. I need more software. So they buy more software. I need a new value line because I haven't spent more than 5 seconds on the last one. I need that. So unless I've got that, I need to find something else. Oh, my computer's not very good. I better get a brand new computer. It's not very fast. And then there's always another reason. There's always another excuse not to do business. And that's something that a lot of retail traders find themselves getting caught into, is that idea. There's a possible sell there. You can see that there is a red area. This is now starting to diverge off the highs. It's ran into the top edge liquidity here. And that would have been a quick short sell just there. And it's dropping off relatively nicely at that point. But yeah, I mean, the whole point about a software is it something that you're going to be wanting to use? If you're not, seriously, don't bother putting it on your chart. Don't start building it out. Don't start thinking about it, because it's just taking you away from the point in hand, and that is making some money. And it's like everything else. The more chance you've got of putting it off or using it as an excuse because you don't have that or you don't have this, then you can already recognize the majority of retail traders, because the majority of retail traders are exactly in that situation. They're always they don't realize they are, but they're looking for an excuse not to do a bit of business. They're looking for an excuse not to find the next trade opportunity. So make sure you don't fall into that situation as well. That's a good sell now, isn't it? That's turned out to be a really nice sell. That trade there, by the way, just for completeness, that sell at the top edge was 6,008 approximately, and just dropped there to 6,002. So that was about 6 points or $300 on that quick drop there. So that would have been a very nice quick short sell into that little cheeky phase. Okay, so what we're going to be touching on next week, of course, in Classroom and the workshop, is we're going to be touching on excess. You'll hear Mike actually mentioning excess quite a lot, and and I'm not sure if Mike's use of the word excess is going to be the same as what I'm going to be talking about here, so Mike can inform us otherwise if it's not the case. But the whole concept of excess comes from market profile, not exclusively, of course, but market profile became very, very well known for this concept of excess. And I've actually found an interesting site that gives a little bit of a background to it, which for next week's classroom actually might be quite useful. It's a site called QuantView. And the reason why it's interesting is it saves me typing out crappy screenshots onto screens, right? So we'll just scroll through this QuantView basic understanding of excess. So this is it just here. Okay, so this is QuantView's understanding market profile excess. Okay, so this is kind of what we already drew, isn't it? So this is why I thought this was quite useful, because when I saw this, I thought, well, this is exactly what I just drew earlier. So instead of me kind of drawing out whiteboards all the time, it'd be quite nice to see a slightly more professional presentation on this concept of excess. But that was what we drew earlier, yes or no? The idea of excess. So for all the guys that are market profile guys, I'm surprised you haven't heard of this concept before, because I thought it was probably the most understood concept of market profile, bar none, to be honest. But obviously a few of the guys says they've never heard it in line with market profile, which surprises me, because it's one of the cornerstones of market profile when it first came out. And as I said, I don't know if this is how Mike uses it, but this is obviously how we're going to be talking about it. And as I said, Mike can illuminate as if it's not the same thoughts that he has about what excess is or otherwise. And it's this concept of what they call buying tails and selling tails. This idea of prices that are moving into an area that effectively lack conviction, if you like. And they lack conviction because you see that drop off in volumes into those areas. And that results in a lack of opportunity for the price to keep going higher. And we'll obviously touch on that. So what is excess? And they suggested excess is buying tails and selling tails. I'm not buying their definition in terms of excess. I think that's kind of a rubbish definition, but we'll go with it for the time being. And we'll obviously explain why. For the market to achieve its primary goal of trade facilitation. Now, there's that old-fashioned thing that everybody's heard in the past about the idea that the whole purpose of a marketplace is to facilitate trade. It's to facilitate buy and sell orders. Well, any marketplaces, that's the case, right? eBay is existing to facilitate trade. Would you agree with that? Or Vinted or Depop or whatever all of these auction sites, I don't even know if the other ones are auction sites, but eBay is. So these are all, Amazon facilitates trade. They provide product and you can buy the product. Now, I know you're not auctioning for the product, so it's not an exact example. But eBay is a good example because there's obviously product there that you can bid into an auction for. And it's up to you how far you take the auction. If you want the product really hard, really, really badly, you'll pay a higher price if somebody else is auctioning for it. Right? If it's a competitive auction, you've got to keep lifting your bid to win the auction, haven't you? Everybody understand that? Maybe some of you have not came across these ideas or eBay in the past. I'm sure most of you know at least what it is. So here we go. It's the market to achieve its primary goal of trade facilitation. It auctions lower to find buyers. It auctions higher to find sellers. Well, this is interesting because this kind of comes back to the concept of what the question was from earlier. So forgive me. Who was it that asked the question earlier and says we would be touching on it in classroom? Now, I'm going to make a real fuck up of this name, but Jacek. That's terrible, isn't it? But I don't know how to pronounce the name. Jacek. All right. So asked a question earlier and said, what? What was the question? What was the question? The question was very simple. If 90% of what we see is rubbish, why bother having it on the charts? Well, this is the reason why. This is the reason why, exactly written here, right? Because for the market's purpose, it auctions lower to find buyers. It auctions higher to find sellers, right? So if I look at any chart that has order flow, and we'll go back to a chart we'd taken a screenshot of before, so it's way over here. If I look at that chart there, can everybody see where you could auction higher to find sellers at? Can you see it? Well, we can actually highlight the area where we could find sellers because we know that there's sellers in this pocket here, right? So if I was to auction the price higher to those sellers, that would achieve the purposes of a normal auction, wouldn't it? I'm not auctioning higher to find buyers. I'm auctioning higher to find sellers. Well, I know there's sellers here. whether they're real or not isn't actually that relevant at this stage, because I don't know if they're real. Nobody knows. The only person that knows if these orders are real is the guy that's put them there, right? So this gives us this idea that what happens then ultimately with the auction is it'll come off the baseline here, and it'll trade towards that area. Do you understand that? And what will happen in terms of a normal profile then at that stage is it'll come up into that area, and the profile would be expected to then do that as it finds sellers and buyers matching up in that area. And as if it does find sellers and buyers matching up into that area, there's a couple of things that could happen, of course. The maximum buying could come in here, right? So instead of it reaching this area, we might argue that the maximum buying all poured in at this point, in which case when it touches into that area, there's no buyers, any buyers left. And these guys say, well, if there's no buyers left here, well, I'm going to have to maybe even cross the spread to get selling if these guys are real, correct? In other words, what happens is you start becoming a competitive seller, and if you start targeting into buyers at that stage, you would start to see a buy-side liquidity maybe starting to pile in this area. You start selling down towards those buyers. In other words, price goes to the liquidity, whether it's real or false. And as you rightly mentioned, 95% of all this liquidity here is false. 95% of it is false. Did these buy orders buy? Did these buy orders buy? Did these buy orders buy? I mean, some of them might have. Did these sell orders sell? Some of them might have. But generally, the answer is no, they don't. Because the price just goes to them to see if they're there and see if anybody's there. And most real sell orders are, most real buy orders are profit-taking orders. Most real sell orders are profit-taking sell orders. Because the one thing I do not want to do as a short seller accumulating a short position is let anybody know I'm short selling it. So why the hell would I advertise my short sell? So if you were a short seller, what would you be more likely to advertise, Reeve? You'd be more likely to advertise a big buy order, right? You'd be more likely to try and punch a hole through a top edge or whatever by buying into the push at higher prices. You'd be more likely to do that. And that's going to bring in a lot of buying. And that's okay, because that's what you're hoping it's going to do, is bring in buying. So we then have to tie that in with the other stuff that's happening elsewhere. The smart money, for example. So if the buying is visible, we see the buying coming in at higher prices, and the smart money is buying, then there's no chance of us ever doing a sell trade, ever. We just let it go through. If the smart money, however, is selling to the advertised buying, we know that that could be something quite interesting, couldn't it? Could be something quite interesting. There was a good example of that actually on the NASDAQ micro, just after 3 o'clock. And you can see an example of it on the screens just here. There's a good example with the smart money coming in, look. So you can see a good example with smart money during this phase. There's a lot of buyers in here, right? And there's a lot of buyers here, and none of these orders get filled. And obviously what they're trying to tap into is this liquidity up here. And at this stage, the smart money's still buying. So you're not really getting any sense that there is maybe a short sale accumulation kicking off until what happens? Oopsies, wrong chart. 1 second, guys. I've just lost my plot. There we go. Until what happens? Well, you see on this candle here, it runs that stop, doesn't it? See how it runs the stop here, but the smart money's now selling it when it runs the stop through the top edge here. So you're starting to see the smart money selling the stops, which gives you an idea that that liquidity below us is probably now false. Because if they're now selling the stops, why are they selling the stops if there's buy liquidity? So what I'm now expecting is when I see that happening, I now expect to see this liquidity pulling as the price drops towards it. And the liquidity you can see here does pull as the price drops towards it. And as the liquidity pools, the guy that sold up here now knows how many sellers are coming in, how many buyers are still there, and then has to make a decision as to whether we're going to get another testy top edge at 800 or whether they're going to have to get competitive at a lower price. So what happened? They started to bring down their offer, didn't they? See how they brought down their offer now with the smart money now selling it? And as the price then rallied, because they've still got this buy in here, right? So when the buyers then lean against that buy and the price goes up into this order, the smart money sell it and then refresh behind that sell. And at the same time, the smart money is now selling this, giving you what turned out to be a very, very, very good short sell phase. And we can already recognize when this candle forms here, you already know where the price is going to, don't you? Because the B shape is going to form here. The price will go towards the place that they can find buyers. What are these orders here? Buy orders, right? So the price will move towards buy orders. Especially when you see the smart money is now selling towards those buy orders themselves, right? So we get this incredibly powerful storyline through that phase with sell side only towards these buy orders. Now, whether these buy orders, going back to the question, are real or false becomes almost irrelevant, doesn't it? Almost irrelevant. Because we don't care. We really don't care if they're real or false. We just know they're there. And whatever happens when we get there is going to happen when we get there, right? And this takes us to the next piece of that jigsaw puzzle. The next piece of this jigsaw puzzle, of course, then starts to focus on the concept, of course, of volume. And we go back to the profile, guys. So I hope that answers the question about why bother having it. Because if I know that that's a storyline here, it also gives us something else to work with. Any idea what else this gives us to work with here, guys? If I know that the price is going to trade to this area here to find sellers, it's exactly right, Sebastian. It's going to give us a dealer's range, isn't it? Do you agree with that? It's actually going to give us a dealer's range. So what we would then say is, well, if that turns out to be real and the buyers pour in at this price, which you can see obviously from the candle shape, the buyers poured in at that price, right? So that's probably the mid price. Sebastian's absolutely right. That's now probably the mid price. What if the buyers didn't pour in here? Well, that's probably going to start dropping towards the price on a competitive seller's auction, right? So if that's where the buyers poured in, what was the low swing? The low swing was the 630, agreed? What was this price here? $700. What do you think the dealer's target price is? $770, right? How far did the price go? $770. So all of a sudden you've now seen something that even the guys that sell the software don't even know about in some respects. You've seen how the dealer's range starts to become visible. Now, we don't know what the bottom edge is at this stage, but we certainly know where the mid price might be or the sell price, because this is either the mid price or the sell price. It's either a P shape or it's an exhaustion print. Because think about it from one of two angles. If you come up into this area and the volume's dropping, then of course these sell orders will be able to absorb any type of buyer up here, wouldn't they? Any type of buyer, because if the volume's dropping, then they'll absorb whatever's there and they'll probably have to cross the spread to get a real short in play. But if they're not real, they must be the mid price because they're advertising a seller there, trying to get people to say, well, there's sellers above me, let's drive into those sellers. And if the volume keeps building, and these sellers say there's too much volume buying coming in, I'm pulling away my sell orders, that opens the door to a measured move. Crazy, isn't it? So we see this stage process. We see this idea of stage process evolving. And we can obviously start looking at it saying that kind of makes some sort of perfect sense. That idea makes sense when I see that storyline coming in. We saw that similar situation to the screenshot we had. The top edge was 21,800. And then we saw this idea that we had some volume below is at 21,710. Do you agree? Well, let's look at it. Let's take a look, and we can verify that that's indeed the case. It's the one we just looked at, guys, so it's not really surprising. Okay, so let's, I know there's a lot of screenshots in here. Okay, so there's the one we just looked at. Remember, we talked about the sell coming in. So if you look at that screenshot and I say to you guys, okay, so let's assume that we've got this weakness at the top edge up here, and we've now got that volume there, right? So we can see where the volume is. It's right there. You see it? So there's one or two things that can happen there. Either these guys are real buyers and the price exhausts into this area and the price then reverses, or there's going to be a big surge in sell orders in this area. There's going to be a lot of sell orders coming in here that starts to create that type of pattern. If there's a lot of sell orders, then this range is now the dealer's range, right? That range there is now the dealer's range, which is now 0 to 10. So where would you imagine a buy order would come in if you're 0 to 10 on the dealer's range? 800 to 710. Where's the buy order going to come in? $800 to 710. Where's the buy order going to come in? $620, right? So you're going to look at that and say, well, the buy order is going to come in at 620. And you start looking at 620 and you say, well, these orders could be real at 620, couldn't they? You see that? These orders here could actually be real at 620 because that's where you would imagine the dealer's range would actually extend to. See how nice that is? Well, you might say, well, is it nice? Well, let's see what happened at 620. So the price drops down to 620 at 3:30 this afternoon. And what happened at 620? It rallied from 620 to 740. Well, that little bounce trade there, I mean, I know the smart money didn't go long, but they can't determine whether they're long or short. They can only respond to the buyers and sellers. But we saw that the buy came off the 620s and ended up trading 740s for over $2,000 profit per contract in 10 minutes. That's what happened. And you already knew about the 620 bottom line price. Whether you liked it enough to buy it or not is a different question. We're not saying you would have. We're saying at least you knew about its existence at exactly that point on the chart because you did that amount of work with this process. Which makes life really quite exciting, doesn't it? Because it seems like we have the opportunity to find some of these trades, haven't we? We've now got the opportunity to find this. Now, this is where it gets a little bit interesting because you obviously can now recognize this buy trade that came in here. What time was the buy trade there? 3:30, right? So the buy trade in the buy area was 3:30. What chart did we start showing you at the beginning of today's classroom? Did I show you the possibility of a buy trade on the S&P? What time was that buy trade on the S&P where we got 3 possible buy trades on the S&P, guys? What time was it when we got 3 possible buy trades on the S&P? 3:30. So the 3 possible buy trades that we had on the S&P based on the PREM turning around and the price of volatility improving was exactly the price that we thought was going to be the dealer's range price from simply looking at the order flow and the projection of those order flow keys. Well, that's quite useful, isn't it? That, my friend, is what we call confluence. Retail traders think confluence, or retail gurus think confluence is your stochastic doing the same thing as your MACD that does the same thing as your CCI that does your same thing as your RSI. That's what their confluence is. Absolute bollocks, in other words. Whereas real confluence is looking at the fact that we actually have potentially a buy program building into a discount price at a level that we know is possibly going to be supported by this simple technical process of dealers' ranges. Dealers' ranges that we knew beforehand, and then we're just looking to verify on the right-hand side if it were to show up. And the outcome, $2,000. Quite nice. So you can see all of these things dovetail in together, don't they? They all end up kind of becoming a thing. You know, and yeah, things can change, stories can change, narratives can change very quickly. But the point is that at least we're in the right place, looking at the right things at the right times. It gives us that opportunity to consider this. So we go back to the original question. Why is there any value in knowing this stuff then? Was there value, for example, therefore asking, going back to that question, was there any value in knowing whether this was a real order or a fake order or whatever? It doesn't make any difference then, does it? Because it still gave us this price, suggesting that that's more likely to be a real order, should we ever get there, and should, when we get there, have buy-side value attached to it. Excess. At the core of this excess idea, of course, is the idea of, is it really excess? We might argue that, how do we define that? Is it, how do we define whether something's real excess or simply a new market directional pop? And this comes back to this idea of I1 or I0, this idea of permanency. So when you saw the news last night of Israel attacking Iran's nuclear facilities, is that a permanent piece of information, or is it something that could be retracted very quickly? It's probably permanent, right? It's a permanent piece of real information. Now, there's always a chance that they could come out and say, well, actually, it never happened because what you heard, what the explosion you heard was actually something else. It was nothing to do with Israel, blah, blah, blah. That can always be the case, right? So we can obviously understand that in most cases, but that's not likely to be true in this case. Why? Well, we had already heard America had started to move some diplomatic staff and various other things were going on. We'd already heard about them shutting down some airspace around those areas. In other words, there is going to be an advised military strike, and it's going to happen. So when those explosions take place, you're now almost 100% certain that the news that we're hearing is real, and therefore it has an I1 score or a P1 score. And a P1 score means you're buying from the inside out or you're selling from the inside out. You're not fading that news. Does everybody understand the difference? Here's a good example of using volume to score your charts. This idea of permanency. So if I look at this idea of permanency, which is I1 versus non-permanency, or mean reversion, which is I0, right? Everybody understand the notation on this? I1 is permanent, I0 is mean reversion. It's not positive or negative in this case. It's just simply 1 means a permanent break or 0 means a false break, effectively, right? So when we look at this, in first blush, we're trying to build that profile narrative from this storyline here. And as the volume increases, we're trying to argue that this is now forming what turns out to be a simple P shape on your profile. You agree? Well, a P shape says that buyers are willing to buy at higher prices. Yeah? Well, if buyers are willing to buy at higher prices, you would imagine that the market's probably really bullish. Had we broken market structure, the idea in that scenario would be, well, we're certainly going to buy a pullback if the volume starts dropping off. You'd maybe start looking at the halfback pullback to maybe buy into. When the halfback pullback comes in and you see the volume starting to increase, you give yourself a little bit of space, a little bit of time. Now, when we tap into the bottom edges, of course, we see that the volume has been increasing at that stage, and we say, well, wait a second, This is now an I1 sell trade or a P1 sell trade, suggesting that if that's real volume, the target price to be a buyer would probably be down here. Would you agree with that? When the price rallies, one of the things we start recognizing is that the volume is now declining in this little space here, and it's absolutely declining against the previous high volumes. I'm starting to get a little bit concerned about this as a storyline. If this price were to pivot from this point, which it does, you can see we get 2 red candles there, I'm now looking at this and saying, anything above this could now be market excess. Well, did we agree that that was our definition of what market excess was? Did we agree at the time of looking that this idea of market excess is when we start moving beyond the volume area or the value area into the rubbish at the top edge or the bottom edge, into the no volume areas? Well, no volume is no volume. So in other words, a drop in volume would agree with that definition, wouldn't it? A drop in volume would agree with that definition, surely. Don't call me surely. So we can obviously look at that as a storyline, and we look at this here, and we now go back to this definition of excess. For the market to achieve its goal of trade facilitation, it auctions lower to find buyers. Well, we've established from the limit order book that that's a thing. But we've also established from transacted volume on a volume chart that that's also a thing, right? So we've got 2 specific ways of starting to think about this. So we don't know what was happening at the top edge. There might have been a lot of sell-side liquidity. And when there's a lot of buy-side volume, it all depends who wins that battle, because it's going to be a battle, right? It's going to be definitely a battle. 1 second, please. Starting to work on this concept, 2 ways of starting to really work out what the excess is. The good news is we can do this on the right-hand edge of the charts. We can start planning out that excess area in advance, and then we can adjust it as price trades to that area. We can make a more informed decision as the trade becomes more relevant in terms of the location and the time. So when we look at this, ideally the market finds a value range where both buyers and sellers perceive price to be fair so that 2-sided trade can take place. Well, we understand fair value as a middle price. The one thing that we use as a slightly different terminology is this idea of unfair. This idea of unfair. Well, I kind of disagree with the profile guys in terms of that wording, but it's only a wording, so it doesn't make any difference. I think an unfair price is when the price is moving. That's how I think of an unfair price. It's unfair on the sellers to be a seller, and it's very fair for the buyers to be a buyer. That's unfair for the sellers. And there's a complete 100% agreement on that, right? And this is one of the words that we disagree with the profile guys. They say there's a disagreement. Well, I think you have to be more careful with that definition. A disagreement, absolutely. But there is agreement that that's not a sell for you as a seller. So the buyer thinks it's a buy. You agree with them because you're not selling it, right? You agree with the buyer that it is probably a buy, and that's why you're not selling it, and that's why the price goes up. So there's an agreement on that idea. There's an agreement on the value there. So when we look at this, we can obviously keep going. However, the market is effective, not efficient. Consequently, it's an attempt to generate trade with all participants. The market occasionally creates excess by auctioning too far in a given direction. It occasionally creates excess, almost as if it's by mistake, isn't it? It's almost as if it's by mistake, but I don't believe it is by mistake. I believe it's by design. The idea, of course, is that if I want to be a buyer, The one thing I don't really want is I don't actually want this tail here. I want to try now and run into that area, get as much liquidity as I can, and then pop it back inside value here. Let's carry on. What is excess in market profile? Excess usually highlights the end of one auction and the beginning of another. Don't disagree with that at all. No excess is frequently a sign that the auction in that direction has not been completed or has not reached exhaustion. I agree with that. No excess. In other words, the price is going higher and buyers are coming in. The sellers are selling some business and there's still a lot of buyers. Well, why would you want to stop the price going higher? If you're a seller, you would then pull the rest of your sell orders to go higher still. And the price keeps going higher. The price keeps moving up and you just keep agreeing with that idea. So this is no excess at this point. So we can now agree on a definition of no excess. A higher price candle with higher volume. A lower price candle with higher volume. Anything with higher volume is a no excess candle, right? So this is a no excess is frequently a sign that the auction in that direction has not been completed. So in a no excess candle, if you can define that, the one thing you're never going to do is fade it, because it's not reached an exhaustion print at that point. Such zones have high probability of revisits in the short run. No shit Sherlock, of course they have, that's what we just talked on. Or if market revisits that area, we are looking for at least a couple of ticks higher. Absolutely, because you're then fading a day high or fading a day low. But here's where we start getting a little bit more clever. If we see these excess areas on the upside below VWAP, that should never exist in a million years. Never exist in a million years. So when we see it, it's a unique area to try and trade into. Finding excess below VWAP on the sell side means that you've got a great trade. You're probably going to keep pushing into that B shape at the bottom edge until we start seeing a bottom line excess. Let's see what they say about buying tails and selling tails. I think Mike's mentioned that phrase before as well. Buying tails, they occur on the bottom of the profile. They're called tails because they have at least two single prints. Buying tails indicate the end of a downwards auction. Failure to have a buying tail indicates an uncompleted downward auction. Failure to have a buying tail. Don't necessarily agree with that particular definition, because it depends how many sellers are in there that's being absorbed, and it depends how much exhaustion you're getting. We know that the market turns as much on absorption as it does on exhaustion at times. We know that for a fact, so we know that that's something that we watch for as well. Selling tails, simply just the opposite of buying tails. So when we look at these very simple ideas, does everybody now understand what excess is? Simple, basic definition of excess. And it's quite a clean definition, though, isn't it? It's quite a clean idea. So when we think about that excess idea, can we then look back at this chart and start seeing this concept of excess by looking, for example, at market volumes? Well, if we look at the volume rising here as the price rises, we would say that that has no excess, correct? It hasn't finished the auction, if you like. There's still plenty of buyers willing to pay higher prices still. Does that sound like an auction that's finished? It's not like eBay where there's a time limit on this trade, is there? There's not a time limit. It's got to finish by then. There is a possibility that it could go on for hours potentially. So we start to recognize that this is no excess, and therefore we've got to try and create excess if we can. The best way to create excess is to find a drop in volume at higher prices, because that looks like a finished auction, doesn't it? Do we see a drop in volume at higher prices? Yes, we do. There's a drop in volume at higher prices. Did we know we were going to get a drop in volume at higher prices? Possibly. Maybe the value was heavy sell side. Maybe we thought that might be the case. But whatever it is, we can recognize that it's now dropping. So what am I going to do at this stage? I'm not going to start selling it because I don't know if the excess is going to keep increasing in volume. Maybe the next candle is even higher volume, right? In other words, we haven't put in a pivot price to define that volume as real. Because you might say, yeah, but what happens next? Well, we know that what could happen next, of course, is if we imagine this candle here, right? See this green candle here? Well, if that candle opened and then the price started to drive higher and then this volume came from this level here and started to go up, if you just sold the previous candle, you just got stopped out, didn't you? In other words, your excess has to now be in the market and visible for you to make a safer trading decision in that area, don't you? Well, we see that the candle here has actually got significantly smaller volumes. We also then recognize that the candle pivots into a sell candle right there. We've now got an excess price on our screens at 636. Do you agree with that? So above that price sits beautifully into what these guys would then call a single print, or what they might then call a selling tail. We already know that that's the case. The problem with profile is they only know that's the case after the event. We know that's the case now. Before the price even goes into that area, we know that there is a very good chance, unless when it goes into that area, the volume increases. So when we watch that price going into that area and we start watching the volume and it's nowhere near increasing, we've now got our answer to what's going to happen next, haven't we? That candle is excess. Not because it's sold off and there's a beautiful selling print tail on it, but because we can actually recognize that the auction's probably finished at that point. If I want to now get filled on my sell order, would I be able to put my orders above the top edge of the market and get filled? Not a chance, right? So if I want to get filled on a sell order now, what am I going to have to do? I'm going to have to sell into the buyers below me now, aren't we? Any buyers that are now below me, we're now selling into. We're now going to chase that buyer liquidity that's probably pressed up underneath the buy orders. And I can now sell into that liquidity as much as I need to try and get my order filled, which then turns into the buyers pulling away their bids and the sellers now pressing in their offers. We get a concept called a refreshed order book. The selling comes in after we get the trade on the books. The selling comes in after we get the trade on the books, yeah? And you see that then getting, so in other words, there might have been sell orders up here from the limit order book before, right? So the sell orders are all up here. Well, that's not selling that I'm interested in. That's going to pull the price towards them. The sell orders I'm interested in is the sell orders that come in after the sell is now in play to defend the original sell order. And we call that a refreshed order book. It's almost as if people think that they've reinvented the wheel because of this. We've been talking about it for the last 10 years, and people were talking about this centuries before I was ever talking about it, right? So this is a refreshed order book starting to come in here, and we just simply then start working sell side away from that trade level, with the idea, of course, that we were looking for a narrative. Now, obviously at this stage, we don't know what's going to happen next. We don't know if the market's going to become really bearish or whether the market's going to become mean reversion back off the bottom edges, for argument's sake, down here. But we start watching the volumes and we start coming up with conclusions about those volumes. So we can see that we've got a lot of ways, a lot of tools to start answering into some of these questions, haven't we? As I mentioned, the biggest thing we've got now is this ability to recognize where we are when these questions are being asked. You can see into any of these trade ideas here, you'll see a couple of really good examples. You'll see that this trade goes from here to here. You'll see that if we go back to this narrative and we say, well, how would this paint in terms of this excess discussion it's kind of obvious how this paints in terms of the excess, right? So we'd already talked about this trade coming in here, from here to here. We talked about that narrative there. And then we says, as far as a projection is concerned, the price will probably go up into the 70s. We told you that earlier, right? And we go into the 70s. And when we arrive in the 70s, this liquidity shows up out of nowhere. But because the volume's rising, I'm not necessarily classifying this yet as an excess situation. We can see that there's an awful lot of liquidity here at that point, which is getting put in behind the drive, and then it kind of vanishes a little bit. Now, that's dangerous now for me, because if I'm selling a top edge and they pull away all that liquidity, I'm starting to wonder why they've just done that. I want them to push the liquidity in here to try and drag the price sellers into that area. You can see they did push it into this area here in advance, and that's good news for me, because as soon as they put that liquidity in, I know the price up here is going to drive down towards that price point. So I'm always watching, but what you did see here was you saw the liquidity that started here, and then they did drop the liquidity and now defend into what we now know as excess there. So we now define this as an excess on the chart, and we can now get busy with a sell opportunity, where we are obviously going to hope that what's going to start happening is that they're then going to pull that liquidity, and we're going to end up going all the way down to this guy here. Because at this stage, according to the shape of this pattern, we could now look at this and say, well, realistically, this is the chart here, isn't it? Realistically, that's where the chart would now be at, there. And if that's the case, I would then start being able to project a very simple projection on my screens. I'd be able to look at that there and say, right, realistically, excess is probably going to start coming in around about 680. Which is going to be the measured move from the top edge to where we would imagine we're going to find a battleground. And if that's the case, how would that profile finish? If the bottom edge was now excess here, the profile would end up looking like this, wouldn't it? Which is exactly right. That's exactly right. So, but if it doesn't look like that, we would obviously, and we still see it going into that B shape, into the lower and lower and lower prices. Well, we keep pulling away the bids, and the bids, interestingly enough, will keep pulling away, invisibly pulling away from your orders. The bid will keep pulling as the price starts to move, giving you more and more towards where you would imagine excess may develop into. It's amazing how many times we see these storylines forming, right? So every time you see these charts, it just seems as if these storylines become real. The more we see it, the more obvious it becomes, the more we recognize the story. There's a very nice 30-second chart on the S&P there again in terms of our top line, and we'd imagine that that's a very strong excess. So we'll just drive very quickly into one of the other charts for a second here and see if indeed that was the case. Okay, so let's just take a goosey at this one, guys. This is a top edge, so it's very dangerous. Okay, so don't get terribly excited about this. But take a look at this value storyline, first of all. Okay, so here's the value storyline. Does everybody see a potential sell trade coming in from that value story? Remember, the trade is based around the black line and the histogram. The black line is volatility. The histogram is PREM, right? So if everybody understands that, everybody would now be saying to me, okay, I quite like the idea of maybe selling into this retest here at 1654 if I can get a bit of liquidity here. But what if that's not an excess there? What if it's not excess? Maybe that might be a bit of a problem, because then we got to lean against the buyer and maybe buy at slightly lower prices. Do you agree with that? Maybe buy at slightly lower prices so that we can lean against somebody, because we're going to have to lean against the buyers if there's too much volume coming in. So if we know that that's a sell trade potentially building there, I can then look at that and say, well, let's try and find it from an excess point of view. Remember, we're looking at 1654. This is a 1 minute chart, not a 30-second chart. So if I'm looking at it from an excess point of view, forget all the value lines on the screen at this point, right? Forget all the value lines to the point where I'll take them off. Let's take a look at excess, first of all. So first of all, we also know that we have value at 1654. So we'll just go along to the chart and say, right, there's 1653. So the decision I'm making is on that green candle, right? So let's now go through an excess process. So we can see that the biggest volume candle on the chart is this big volume arrival here, right? Massive volume arrival here. The volumes went nowhere near since. So we could all pretty much agree that that's probably the level that we're interested in. When it goes higher with less volume, we can obviously start looking at the higher pop with less volume here and say, right, if that sells off, I think anything above that price is going to be excess. But what must be accomplished if we go above that price? If we go above that price, we must see lower volumes. So what happens when we go above that price? The volume actually spikes higher here, doesn't it, in the short term, giving us a little bit of a concern there. Because as we go above that price, we should be seeing that volume declining through that phase. So when we see a higher volume, you say, well, short term, I'm still a little bit concerned. Now, on a macro chart, we still have that excess because we can still go back to this guy here. So it's still massive excess against that guy. So we can obviously look at that and say, well, we just have to give ourselves a little bit more caution here. And when the price breaks above the level and we get excess here, the volume's lower, we now have a potential excess price level right there, don't we? So when we went above that price on the candle in question, did the volume increase or decrease? It decreased. You've got your sell order. You've actually got your sell order. You've just found excess on the chart at that exact point. And because you found excess, you don't need confirmation. You don't need confirmation that it's excess. You've got excess. The volume dropped. So you already knew it was excess because your one candle at that stage in the world of short-term trading, this was your one candle there, wasn't it? And this was your excess here when it sells, and above that is now your excess zone to sell into. Above that is now your excess zone to sell into. And obviously selling into that excess zone resulted in a reasonable little cheeky profit right there, wasn't it? You got in maybe around about 840s. Within 2 minutes, you're trading at 810s. You make yourself $600 or $500 in 2 minutes, and you say, well, that was a nice way to make a living in it. Pretty pleasant. Easy stuff done well. You see how you were able to now top tick the price by going through that excess process? Top tick the price, guys. So we start understanding this idea of excess, this idea of P equals 1. Because at this point here, when we look at this break here, P equals 1 or I equals 1. When we look at this break here, we could argue that P equals 1 or I equals 1 again. But when we break through this area here, we see that drop, we say P equals 0, I equals 0. In other words, mean reversion is more likely. Think about the logic of that. It's not just basic arithmetic or algebra, is it? Mean reversion is more likely. Well, why would that make sense as a statement? Why would it make more sense? Is everybody understanding this? Why would it be more sensible to mean revert at that point? What's the primary goal of a marketplace? What's the primary goal of a marketplace? To facilitate trade. And if you keep going higher and the prices and the volume's getting less and less and less, are you facilitating trade in the most efficient manner to make you a lot of money? No. So if you're not facilitating trade at higher prices, where's it most likely to go to find trade? It's most likely to go lower to find trade. Did it find trade when it went lower here? Sure. So it's doing its job now, isn't it? The market's now doing its job. So you're looking at that saying it found trade at lower prices. Never found any trade at higher prices. It found trade at lower prices. So at this stage here, is this excess below here? No. It might turn into excess. If we drop through that area and the volume is now dropping off to nothing, then there's a chance that it might start finding excess, which then puts in, for example, a pivot, right? So maybe the price drops and the volume is really low, and then it pivots here. Have we just found the excess zone on the charts? Yes, we have. At that stage there, we would then say we've now got an excess zone here that we may be going to tap into if we ever trade it. If the value ever suggests that we should be selling this or buying this, that gives us our area just like it did at the very top edge where we found excess here. And we says there's our opportunity to sell into that excess zone there. Excess on the drop is crazy. We're not often going to get it, to be honest, because it normally simply doesn't exist in this area. But we also understand the idea of market structure gives us this. The idea that the price itself, without even asking the question of volume, if the price breaks structure and holds a break of structure, it's effectively creating what we would then call a time price opportunity, which is a profile concept, right? So they're not necessarily looking at volume, they're simply looking at the fact that price did it. Yeah. So when we're looking at the fact that price was successful, this opens the door to understanding excess purely from the price action point of view, without even volume as an indicator. Just imagine when you start adding indicators like volume and value, order flow, your ability to read these stories becomes incredible. So for example, in this area here, we started to see a break in structure here. It's not a great break in structure, but the price holds down here, doesn't it? It rallies here and sells. Well, if it rallies here and sells, we're already defining that as an observed excess because it effectively created what is now a B shape in the marketplace. If that's excess and this is now a B shape in the marketplace, you're automatically going to say to me, I would imagine, if that, for example, is now going to build into a POC level, and I go up to the top edge here, which was the previous swing high, as far as a normal distribution is concerned, I think the price is probably going to trade from here down to this box here. Would that be reasonable? At least to start with. So when we start looking at that, we say, well, if that's the case, taking us into this area here and taking us down into this area here, I would imagine if that's already been seen as excess, because otherwise, why did somebody sell it in the first place? I might not agree with them, but why did somebody sell it there? The fact they did is not our problem. The fact that they did is actually our opportunity. So if somebody's seen that price there as excess, and this is now the build of value here, anything above that is now a possible trade into that excess zone, isn't it? So we start recognizing the excess zone as an area between maybe 50 and 75% pullback. The excess zone is now visible. We may want to tap into that if we've got the other clues. We can start adding a volume narrative to those other clues and so on, and things become that little bit clearer. As we then break market structure again in terms of TPOs, you'll see that when we break that market structure, of course, then we start seeing these sellers coming in these areas, whether it's this one or this one. We kind of already see that somebody thinks this is excess already here, don't they? Somebody thinks that's excess because somebody sold it. Well, if somebody thinks that's excess, we're already starting to consider the possibility, like we did here, that this area here, going all the way up to the 75, is probably an excess zone. And if we like the trade, we may have an opportunity to sell the trade. So when this price drops down again and breaks market structure low, TPOs are now sell side, and then we start seeing a seller coming in here. Do you see the excess again there? And we just do it again. And if we like the sell, we get another sell and we keep it going. You might remember that we actually called out that this was not an excess here. Well, you'd already seen the fact that nobody sold here anyway, did they? Remember what we saw here to find an excess line was a seller coming in? Well, in a lower time frame, that becomes a what trade? On a lower time frame, that becomes a spring trade, doesn't it? On a lower time frame, that becomes a spring trade there. On a lower time frame, that becomes a spring trade there, doesn't it? So these are all spring trades into an area that we would now define as a market-derived excess at lower prices. And if you sold these trades, how much easier were these sell trades versus these sell trades? How much easier? Well, put it this way, we traded this entire area, perhaps from 2:30 till approximately 3 o'clock, and we've made almost nothing. Correct? Almost nothing. We might not even have made anything. Maybe you've scratched out, maybe you've taken a +1, maybe you've made a small profit, or maybe you've not made anything for a half an hour and maybe you've not made a penny. What happened as soon as you sold here? Did you start making money? You started to make money and then you made big money. As soon as you sold here, what happened? You started to make money and then you made big money. As soon as you sold here, what happened? You started to make money and then you made big money. Well, what trade's easier to do? Making the big money trades that go into profit almost immediately, or the slow money trades that take half an hour before you've even made your first dollar's profit on the top edge? Starts to become dead obvious what the easier trade is, isn't it? The faster trade, the quicker trade, the trade that will actually make you more money. Even though you think you make less money by selling at lower prices, you find that actually your price amount of the money you make over time is a lot higher. Better use of resources, better use of your time, and you're going to make a lot of money very, very quickly during that next leg of the process. Excess. That concept seems to now become incredibly ingrained in everything we do, from volume to value, from price action to individual candlestick volumes. So we start recognizing that we've now got a lot of tools. We've now seen it from a limit order book point of view. We've seen it from a delta point of view. We've seen it from a levels point of view. We've seen it from a price action point of view of prices holding in certain areas. Recognizing the concept of excess, allowing us, if we like, to take a shot at certain trades. So these are all quite useful, aren't they? In their own right, any one of them could be traded almost without any indicators. We can start to recognize structure breaks. We can start to look for those excess trade ideas. We can start to consider the idea of whether there is excess, and we can start to tie them in. But on their own, they still leave massive questions. And this is why when people find they pick up a book on profile or they pick up a book on price action, it might be interesting, but it still doesn't give them the right questions being answered. Because you'd say to me, well, you know, realistically, Ray, that's a seller coming in here, so above that line's excess. And you say, but where is that price? Oh, but wait a minute, what's that got to do with anything? And then you have to introduce a brand new part of the subject, don't you? Because if we find where the excess finally shows up because a seller comes in here, where is that price? Is it between 50 and 75 of the previous swing? Well, there was a swing low, and there was a swing high, and you'll find the excess almost exactly is through into the top 25% of that bracket, right? So it seems as if it's gone too far. Because if it goes into the top 25%, where's the nearest liquidity? If you were to look at the limit order book at this stage, where do you think the nearest liquidity would be? Just at this stage here, right here, see that right there? Where would the nearest liquidity be? Think about it. And I'm talking about limit order book liquidity. Do you not think that there's going to be, for example, do you not think there's going to be a very large series of sell orders at that price area there? There's certainly going to be a lot of buy orders there, isn't there? There's going to be a lot of stop orders there. There's going to be a lot of sell limit orders there. So is that not going to be your new P-shape area that you're going to be aiming for when you go into the top 25% of the bracket? And that becomes what we then know as a BSG squeeze when you're trading into those P shapes or B shapes. So you would then look at that and say, it's gone too far. You know, the magnetic pull of liquidity down here, or even the 50 line, is less than the magnetic pull of that liquidity there. There's a higher probability of us now going into that trade area, at least into that trade area. And maybe it's going to revert back into middle prices. But it's certainly not a momentum trade anymore. It's now a rotational trade if it was to do that, right? You'd look at that and say, well, if it goes into that area and it sells off, then that's rotational. But it doesn't sell off, does it? It doesn't sell off when it goes into that area. It continues going. And then we say, well, did it continue going on increased volume? Yes, it did. It continued going on increased volume, didn't it? Look, the volume increased. So if the volume increased, we know that this is the one candle and we're probably going to keep going higher until we hit something else, right? So we could look at that and say, well, the break of that market structure probably gives me an idea, because if that break there is where all the volume is, and realistically, it's probably right on that price. Would you agree? Well, if it's right on that price, does everybody know where the target price is likely to be as well? The target price, if it goes into that area there and the volume just increased on the break of that market structure, is now going to be that price there. It's called the dealer's range. Do you see it? Can you see the dealer's range showing up there? And then all of a sudden, as soon as we hit the dealer's range, what happened to the volume since the dealer's range came in? Was the volume increasing going into that dealer's range? The volume was dropping off, giving us this concept of excess into a price that we would expect to see excess at. So if I'm expecting to see excess and then I see excess, could I not maybe take a shot at some selling up here? Is that not a possible thing here? Is that not a really high probability thing right there? And saying I can see the opportunity to maybe start selling into the 1540s, that could be a real money opportunity for me to make a very easy trade decision up here, right? And the price dropped off beautifully, didn't it? But did we break market structure? In terms of TPOs, did we break market structure? We absolutely did, because the swing low that was created here was broken at this point here. So we broke market structure here, which meant that we are now in, technically, an uptrending phase. And if we're now in an uptrending phase, where would you imagine excess should show up? Well, we go from swing high to swing low, and guess what we're looking for? We're now looking for the half-back trade area. We're now saying to ourselves, I'm expecting to see excess in and around this trade area here. Did we see a traded excess before that? Yes, we did. We saw a traded excess here because we saw buyers coming in there, suggesting to me on the face of it that any break below that price is probably excess. Did a buyer show up here? Yes, they did. Did the volume drop as the price broke below that area? Yes, it did. Are we now expecting that there could be a possible buy trade around here? Is there a possibility that you might start looking for a buy trade in here into an area that we now deem to be an excess area? And if that's the case, we've got a few questions, a few concerns. What's the biggest concern? The biggest concern is we're going to have to put in some really stiff volume buyers as the price, if it was long, as the price moves higher, because we already know that this area exhausted the last time, right? So we really need to see the volume coming in as it starts to move back up, if it starts to move back up, assuming we've got buy-side value in the first place. And what happened to the trade? Was it almost perfect? Was it almost too good? Not really. You're seeing the idea, you're seeing the process, and then when the price starts rallying into the top edge, you're starting to see this is not excess up here. This is a P1 or a 0 or an I1, isn't it? Right? This is a P1 or an I1 trade here. And you're saying to yourself, well, that's great news. This is a P1 narrative. I'm going to book a little bit of profit, but the one thing I'm definitely not doing is selling this bloody thing, right? And were you right not to sell it? So when the price drops and we get a buyer coming in here, could we then start seeing the same thing? Well, we've now got a traded excess here. Whether we like it or not, we've now got a traded excess. Was the volume dropping? Yes, it was. So if I trade into this area, could I automatically start considering a buy trade? Yes. Why? Well, because it's above the bottom 25% of the move, right? So you'd imagine that if I now go from that swing high to the swing low here, you would imagine that the excess should have been created in this area here. Well, that would almost be perfect against where we saw that liquidity coming in, isn't it? It's almost a perfect trade narrative in this case. It's almost perfect compared to this one, isn't it? It's almost exactly the same. So we can see how this played out. Look, I mean, we never got there. To be honest, we never got there. The volume started to build again as we started to rise away from that very low volume area. And maybe you got lucky. Maybe you says to me, and there is a possibility you could have seen this, but maybe you started to recognize the fact that there was an excess buyer coming in at higher prices there. You might have says, well, on the basis that I never get filled on this area here on the first blush, we've now got an excess buyer here. Why would we say that? Well, because the volume increased from that candle to that candle, didn't it? So if that was the case, you could say, well, that could be excess then, because that was a low volume reversal. And we've got a higher volume high out there. So our drift into that excess could be a buy trade, so long as the volume is less than the previous volume. Is the volume less? Yes, it is. So you would then be able to look at that and say, I could define this as excess. If I like it, I could define it as excess and just buy it straight off the bat. So how did your buy phase do? How did your buy phase end up doing eventually? Well, pretty good. And again, it's about the idea. We never got the bottom edge on that occasion, but we were able to then participate on each of these solid pullback trades into 680s all the way up to a high price of 850s. 170 points, 3.5 grand's worth of buy side profits in a period of about an hour. That's pretty good money, isn't it? Pretty good trading. And we're not even using indicators here. We can improve by using our order flow tools. We can use by improving our narrative in terms of values about whether we think it should or shouldn't be bought or sold. But even without those ideas, using simple profile type concepts, we're starting to recognize that these ideas are now visible on every chart, on every time frame that we wish to care to look for. The ability to find these areas, to define them as excess, gives us a massive advantage in any marketplace. So what we've got to try and do is keep looking for excess stories. We had an excess story here, but it never traded that excess, did it? This was on the right-hand side when we drew that excess in. It never traded that excess, but we found another excess coming in, didn't we, here? So a buyer came in at that price. So when we trade back down into that area, did the volume increase or decrease? It decreased. So could we call this excess here? Possibly. We could certainly get away with it. I mean, there's a lot of ways we could have looked at that and says, yep, that's excess. And you take your shot a little bit earlier than perhaps you thought, or, you know, a little bit later than you thought. And obviously the idea is, well, we've got to try and make sure we get more volume. And as it rises, the volume is getting better, but we're not really starting to get into the same type of volumes as we had here, suggesting that we're going to have to start rotating out of that position as we start tapping into top line liquidity. So it'd be a good idea in that situation to say that's a bit rubbish, in it, especially when the volume drops on the retest up here. You say that's it, that's doomed. That's doomed at that point, right? So again, you see this evolving story, a story that you can all now take advantage of if you wish to, a story that seems to make sense whether you want to press into top edges or bottom edges, or whether you want to fade into top edges or bottom edges. It accommodates either style of trading or both styles of trading. And that's a good thing, because not everybody wants to be a buy and press type trader or a top line fader. The best thing you can do is have the ability to do both, so that when value presents itself, you know how to play out the top edges or the press into the top edges, whichever way the value storyline evolves. So when you see it, it becomes very, very, very visible, doesn't it? The story becomes a strong narrative. And obviously, if you're trying to stay as much as possible on the press, did we have a potential excess there? Yes, we did, right? How did we have a potential excess? Because we broke into a lower low and less volume here, suggesting that this is now excess into this area. And this volume here was pretty sizable. So the one thing you wouldn't have wanted to do is certainly buy into that volume at that stage. But when it drops below that, you can say, well, that's us into an excess potentially. If it goes up, we now have a definite excess level, but it means we could start getting busy with this. If I wanted to, I could start getting busy in here because of the drop in volumes. Again, you're hoping that the buy side volume picks up as it drives higher, which it hasn't. It's dropped off to nothing. We're in lunchtime, guys. It's going to drop off to nothing, isn't it? So if you were going to buy it, that would have been your buy trade there on the lower volume break. Because if that volume was higher, you would not buy it, would you? If that volume here was higher than that volume, you would not be buying that red candle. If it's lower, you might want to buy it, but you don't know yet if it is genuine excess, because the next candle could have been a red candle, and it could have had higher volume, in which case you say, oh, wait a second, this is rubbish, right? And then when the price rallies, you can see the volume, instead of rising, is dropping, and you're probably now looking at that and say, get me off this trade, this is rubbish. And if that was the case, well, that's okay. That's exactly what you would think, right? It's kind of rubbish. So that's what we're going to be covering in the workshop. I hope there's of an interest, certainly, in the workshop going forward. We'll certainly be diving into a lot more detail about all the ways to see these trade opportunities. We'll be looking at the relationship to VWAP so that we can understand how to try and trade the highest probability trades. And we could add in a value narrative or an order flow narrative. But we need to know about the concept of excess first, and then evolve as traders around these ideas. That's all going to start on Wednesday of next week, guys. Wednesday of next week. So in the meantime, I think we'll finish off with that. It is a Friday after all. You guys are probably fast ready to go to the pub and enjoy the rest of the weekend. So we'll get out of here. I'm going to say for one last time this week, adios amigos, arrivederci. Auf Wiedersehen, sayonara, tot scenes. Tak ska do, do svidania. And spasibo, guys. In the meantime, ciao for now.